Question 1. An investment banking representative conducting due diligence for a public offering would typically focus on which of the following aspects of the issuer? A. Developing the marketing strategy for the new securities. B. Verifying the accuracy and completeness of disclosure documents. C. Facilitating secondary market trading activity after the IPO. D. Preparing the issuer's annual financial statements for regulatory filing. Answer: B. Verifying the accuracy and completeness of disclosure documents. Due diligence is a critical process undertaken by investment bankers to investigate and verify information about an issuer before a public offering. The primary goal of due diligence is to ensure that all material information included in disclosure documents, such as the registration statement, is accurate and complete, helping to fulfill the underwriter's affirmative defense against liability under the Securities Act of 1933. For example, bankers will review financial statements, contracts, and legal proceedings to identify any misstatements or omissions that could impact investors. Always remember, thorough due diligence protects both investors and the underwriting firm from potential liabilities. Question 2. Which of the following best describes the role of a syndicate manager in a public equity offering? A. Primarily responsible for selling shares to retail investors without taking on any underwriting risk. B. Directs the overall offering process, manages the underwriting syndicate, and allocates shares. C. Acts solely as a financial advisor to the issuer, without participating in the sale of securities. D. Provides independent fairness opinions to the target company's board of directors. Answer: B. Directs the overall offering process, manages the underwriting syndicate, and allocates shares. The syndicate manager, also known as the lead underwriter or bookrunner, plays the central role in a public equity offering. This firm is responsible for leading the entire underwriting process, which includes structuring the deal, forming and managing the underwriting syndicate, conducting due diligence, preparing the registration statement, and ultimately allocating shares to investors. For example, the syndicate manager will decide the offering price range and negotiate terms with the issuer. Think of the syndicate manager as the general contractor overseeing the entire construction project of a new issuance. Question 3. Under FINRA Rule 5130, restricted persons are generally prohibited from purchasing shares in a new issue, IPO, at the public offering price. Which of the following is not considered a restricted person under this rule? A. A FINRA member firm. B. An immediate family member of a person associated with a FINRA member firm, who lives with that person. C. An investment company registered under the Investment Company Act of 1940. D. A portfolio manager acting on behalf of an institutional account that is not a restricted person. Answer: D. A portfolio manager acting on behalf of an institutional account that is not a restricted person. FINRA Rule 5130 aims to ensure that public offerings are genuinely available to the public and to prevent spinning or other abusive practices. Restricted persons include FINRA member firms, their associated persons, immediate family members of associated persons, if certain conditions are met, such as living with the associated person, and certain fiduciaries to institutional accounts. A portfolio manager acting on behalf of an institutional account that itself is not restricted is generally permitted to purchase new issues for that account. For instance, a manager of a mutual fund, which is generally not a restricted person, can purchase IPO shares for the fund's portfolio. Remember, the rule focuses on individuals and entities that could exploit their privileged position in the securities industry. Question 4. A company is planning to raise capital through a private placement under Regulation D. Which of the following statements about purchasers in a Regulation D offering is most accurate? A. All purchasers must be accredited investors. B. Non-accredited investors are prohibited from participating. C. An unlimited number of accredited investors may participate. D. A maximum of 35 non-accredited investors may participate. Answer: D. A maximum of 35 non-accredited investors may participate. Regulation D provides exemptions from SEC registration requirements for private placements, allowing companies to raise capital more efficiently. Under Rule 506(b) of Regulation D, an issuer can sell securities to an unlimited number of accredited investors but is limited to a maximum of 35 non-accredited investors. While accredited investors are typically sophisticated and high-net-worth individuals or institutions, non-accredited investors must receive extensive disclosure information. For example, a startup could raise funds by selling shares to 100 accredited investors and 30 non-accredited investors. This balance allows broader access to capital while still providing some investor protection for those less experienced. Question 5. In an M&A transaction, a target company's board of directors is typically advised by an investment bank regarding the financial aspects of a potential sale. What is the primary duty of the board to its shareholders in such a transaction? A. To secure employment contracts for the existing management team. B. To maximize the company's long-term enterprise value for shareholders. C. To ensure that the company remains independent and avoids acquisition. D. To protect the interests of all stakeholders, including employees and customers, above all else. Answer: B. To maximize the company's long-term enterprise value for shareholders. The primary duty of a target company's board of directors in an M&A transaction is to act in the best interests of its shareholders, which generally means seeking to maximize the long-term enterprise value of the company for their benefit. This is known as their fiduciary duty. For example, when evaluating competing offers, the board must objectively assess which offer provides the best financial outcome for shareholders, not just the management team. This duty requires a thorough and unbiased process to ensure shareholders receive the highest possible value for their investment. Question 6. A company undertaking a hostile takeover attempt would typically employ which of the following strategies? A. Negotiating directly with the target company's board of directors for a friendly merger. B. Launching a tender offer directly to the target company's shareholders to buy their shares. C. Proposing a joint venture agreement with the target company. D. Seeking approval from the target company's management for the acquisition. Answer: B. Launching a tender offer directly to the target company's shareholders to buy their shares. A hostile takeover occurs when an acquiring company attempts to take control of a target company against the wishes of the target's management or board of directors. One of the most common strategies for a hostile takeover is to bypass management and launch a tender offer directly to the target company's shareholders, inviting them to sell their shares at a premium above the current market price. For instance, if Company A wants to acquire Company B but Company B's board rejects the offer, Company A might appeal directly to Company B's shareholders with a public tender offer. Remember, a tender offer is a direct appeal to shareholders over the heads of management. Question 7. Which valuation method calculates a company's value by discounting its projected free cash flows to a present value? A. Precedent transactions analysis. B. Comparable companies analysis. C. Discounted cash flow, DCF, analysis. D. Leveraged buyout, LBO, analysis. Answer: C. Discounted cash flow, DCF, analysis. Discounted cash flow, DCF, analysis is a fundamental valuation method that estimates the value of an investment based on its future cash flows. This method involves projecting a company's free cash flows, cash flow available to equity and debt holders, over a specific forecast period and then discounting those future cash flows back to their present value using a discount rate, typically the weighted average cost of capital, WACC. For example, a DCF model might project a company's cash flows for the next 5 years and then add a terminal value representing all cash flows beyond that period, discounted to today. The core concept is that a company's value is derived from the cash it can generate in the future. Question 8. In an M&A transaction, what is the purpose of a stock purchase as opposed to an asset purchase? A. A stock purchase typically results in a lower tax basis for the acquiring company's assets. B. In a stock purchase, the acquiring company assumes all liabilities of the target company. C. An asset purchase is generally preferred for ease of transfer and reduced administrative burden. D. A stock purchase allows the acquiring company to selectively choose which assets and liabilities to acquire. Answer: B. In a stock purchase, the acquiring company assumes all liabilities of the target company. In a stock purchase, the acquirer buys the shares of the target company directly from its shareholders, making the target a subsidiary of the acquirer. A key consequence of this structure is that the acquiring company assumes all of the target company's existing liabilities, both known and unknown, because the target entity itself continues to exist, just under new ownership. For example, if Company A buys all shares of Company B, Company A is now responsible for Company B's contracts, litigation, and debts. Conversely, an asset purchase allows the buyer to pick and choose specific assets and generally leave behind unwanted liabilities. Question 9. An investment banking firm underwriting a securities offering is required to conduct reasonable investigation under Section 11 of the Securities Act of 1933 to establish an affirmative defense. This defense is commonly known as A. The de minimis defense. B. The safe harbor defense. C. The due diligence defense. D. The materiality defense. Answer: C. The due diligence defense. Under Section 11 of the Securities Act of 1933, underwriters can be held liable for misstatements or omissions in a registration statement. However, they can establish an affirmative defense if they can prove they conducted a reasonable investigation and had reasonable grounds to believe, and did believe, that the statements were true and there were no material omissions. This defense is universally referred to as the due diligence defense. For instance, an underwriter collects and verifies information from the issuer, its auditors, and legal counsel to build this defense. Remember, the due diligence defense is crucial for protecting underwriters from liability in public offerings. Question 10. Which regulatory body is primarily responsible for ensuring that companies make adequate disclosures to investors in public offerings and for overseeing the securities markets? A. Financial Industry Regulatory Authority, FINRA. B. Federal Reserve Board, FRB. C. Securities and Exchange Commission, SEC. D. State Securities Regulators, Blue Sky Laws. Answer: C. Securities and Exchange Commission, SEC. The Securities and Exchange Commission, SEC, is the primary federal government agency responsible for enforcing federal securities laws, proposing new securities rules, and regulating the securities industry, the nation's stock and options exchanges, and other electronic securities markets. Its core mission includes protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital formation. For example, the SEC reviews registration statements for public offerings and oversees disclosures from public companies. Always remember the SEC as the ultimate guardian of the U.S. securities markets and investor protection. Question 11. Which of the following financial ratios is typically used to assess a company's ability to cover its short-term liabilities with its short-term assets? A. Debt-to-equity ratio. B. Price-to-earnings, PE, ratio. C. Current ratio. D. Return on equity, ROE. Answer: C. Current ratio. The current ratio is a liquidity ratio that measures a company's ability to pay off its short-term liabilities, due within 1 year, with its current assets, assets that can be converted to cash within 1 year. It is calculated by dividing current assets by current liabilities. For example, a company with $2 million in current assets and $1 million in current liabilities would have a current ratio of 2-to-1, indicating strong short-term liquidity. A higher current ratio generally suggests a stronger financial position for meeting immediate obligations. Question 12. In a public offering, the red herring prospectus is distributed to potential investors during the cooling-off period. What key information is typically omitted from the red herring? A. The issuer's business description and risk factors. B. The underwriter's identity and responsibilities. C. The offering price and the effective date. D. The use of proceeds in financial statements. Answer: C. The offering price and the effective date. The red herring prospectus, formerly known as a preliminary prospectus, is distributed during the cooling-off period after the registration statement is filed but before it becomes effective. It includes most of the information contained in the full registration statement, but it specifically omits the final offering price of the securities and the effective date of the offering. This allows investors to review the company's details and potential risks without committing to a price before the deal is finalized. The red border on the cover serves as a warning that the registration statement is not yet effective and the information is subject to change. Question 13. A company seeking to execute a friendly merger would most likely engage in which of the following activities? A. Initiating a tender offer directly to shareholders without board approval. B. Engaging in direct negotiations with the target company's management and board of directors. C. Announcing a hostile proxy contest to replace the target's board. D. Acquiring a significant stake in the target company's stock on the open market without prior communication. Answer: B. Engaging in direct negotiations with the target company's management and board of directors. A friendly merger or acquisition occurs when the target company's management and board of directors agree to the transaction. This involves direct negotiations between the acquiring and target companies to agree upon terms such as the purchase price, deal structure, and post-merger integration plans. For instance, two companies might explore strategic alignment and then negotiate a mutually beneficial merger agreement before presenting it to their respective shareholders for approval. This collaborative approach differentiates a friendly deal from a hostile one, where the acquirer attempts to bypass the target's leadership. Question 14. Which of the following is not a characteristic of a firm commitment underwriting? A. The underwriter acts as a principal and purchases the securities from the issuer. B. The underwriter bears the risk of unsold securities. C. The issuer bears the risk of unsold securities. D. It is the most common type of underwriting for IPOs. Answer: C. The issuer bears the risk of unsold securities. In a firm commitment underwriting, the underwriter, or syndicate of underwriters, agrees to purchase the entire issue of securities from the issuer and then resell them to the public. This means the underwriter acts as a principal and assumes all the financial risk of any unsold shares. For example, if an underwriter agrees to sell 1 million shares at $10 each, they pay the issuer $10 million, minus their fee, regardless of how many shares they ultimately sell to investors. This structure provides the issuer with certainty regarding the amount of capital raised, making it the most common method for public offerings. Question 15. The Sarbanes-Oxley Act of 2002, SOX, primarily aims to enhance corporate governance and accountability. Which of the following is a key provision of SOX? A. Requiring private companies to register with the SEC. B. Establishing rules for the issuance of municipal bonds. C. Creating the Public Company Accounting Oversight Board, PCAB. D. Deregulating the investment banking industry. Answer: C. Creating the Public Company Accounting Oversight Board, PCAB. The Sarbanes-Oxley Act of 2002, SOX, was enacted in response to major corporate accounting scandals, aiming to improve corporate governance, accountability, and transparency for public companies. A significant provision of SOX was the creation of the Public Company Accounting Oversight Board, PCAB, which oversees the audits of public companies to protect investors. For example, the PCAB sets auditing standards, conducts inspections of accounting firms, and investigates violations. SOX ensures that public companies' financial reporting is reliable and transparent, strengthening investor confidence. Question 16. In a divestiture, What is the term for a transaction where a parent company sells a portion of a subsidiary to the public via an IPO, while retaining a controlling interest? A. Spin-off. B. Split off. C. Equity carve-out. D. Reverse merger. Answer: C. Equity carve-out. An equity carve-out is a type of divestiture where a parent company sells a minority interest, typically less than 50%, in one of its subsidiaries to the public through an initial public offering, IPO. The parent company retains a controlling interest in the subsidiary, and the subsidiary then becomes a separate publicly traded company. For instance, if Company A owns 100% of subsidiary B, an equity carve-out would involve Company A selling 20% of subsidiary B's shares to public investors while retaining the remaining 80%. This strategy allows the parent to monetize a portion of its subsidiary's value while maintaining control. Question 17. A tender offer for shares of a target company must remain open for a minimum period of A. 5 calendar days. B. 10 business days. C. 20 business days. D. 30 calendar days. Answer: C. 20 business days. SEC rules dictate that a tender offer, which is an offer to purchase a company's outstanding shares directly from shareholders, must remain open for a minimum of 20 business days. This minimum period ensures that shareholders have ample time to evaluate the offer, seek advice, and make an informed decision. Additionally, if the terms of the tender offer change, such as an increase in the offering price, the offer must be extended for at least 10 business days from the date of the change. This provides crucial investor protection by preventing rushed decisions. Question 18. What is the primary purpose of a fairness opinion in an M&A transaction? A. To provide legal advice to the target company's board of directors regarding the transaction terms. B. To determine the definitive price at which the target company will be acquired. C. To provide an independent assessment of the financial fairness of a transaction to shareholders. D. To guarantee that the target company's shareholders will receive the highest possible price. Answer: C. To provide an independent assessment of the financial fairness of a transaction to shareholders. A fairness opinion is an independent evaluation, typically rendered by an investment bank, that assesses whether the financial terms of a transaction, such as a merger or acquisition, are fair from a financial point of view to the company's shareholders. This opinion helps a board of directors fulfill its fiduciary duties by providing an objective viewpoint on the deal's value, though it does not guarantee the highest price. For example, if Company A offers to buy Company B, Company B's board might seek a fairness opinion to assure shareholders the offer is financially sound. Remember, a fairness opinion focuses solely on the financial aspects and is not a legal opinion or a guarantee of the absolute best price. Question 19. A financial sponsor executing a leveraged buyout, LBO, of a target company would typically rely heavily on which of the following to finance the acquisition? A. A large public equity offering. B. The target company's existing cash reserves. C. A significant amount of borrowed money, debt. D. The sponsor's own unlimited cash equity. Answer: C. A significant amount of borrowed money, debt. A leveraged buyout, LBO, is an acquisition strategy where a company is purchased primarily using borrowed money, often from banks or other financial institutions. The acquired company's assets typically serve as collateral for the borrowed funds, and its future cash flows are expected to be used to repay the debt. For example, a private equity firm might use 70% debt and 30% equity to acquire a target company, aiming to improve its operations and then sell it for a profit years later. This heavy reliance on debt is the defining characteristic and namesake of an LBO. Question 20. Which document is filed with the SEC by a company when it registers its securities for public offering, providing comprehensive disclosure about the company and the securities being offered? A. Proxy Statement, Form 14A. B. Annual Report, Form 10-K. C. Registration Statement, Form S-1. D. Current report, Form 8K. Answer, C. Registration statement, Form S-1. The registration statement, commonly Form S-1 for initial public offerings, IPOs, is the comprehensive document that an issuer must file with the SEC to register its securities for public sale. It contains detailed information about the company's business, management, financial condition, risk factors, and the specifics of the securities being offered. For example, an investment banking firm preparing for an IPO will work extensively with the issuer to draft and finalize the S-1. This filing ensures that potential investors have access to all material information before deciding to purchase shares. Question 21. What is the typical flow of funds in a typical best efforts underwriting where an escrow account is used? A. Investors pay the underwriter directly, and the underwriter pays the issuer after the offering closes. B. Investors pay the issuer directly, and the issuer holds the funds until the minimum threshold is met. C. Investors pay into an escrow account, and funds are released to the issuer only if the minimum contingency is met. D. The underwriter guarantees the sale and pays the issuer upfront, then collects from investors. Answer, C. Investors pay into an escrow account, and funds are released to the issuer only if the minimum contingency is met. In a best efforts underwriting, the underwriter acts as an agent, selling securities on behalf of the issuer without guaranteeing that all shares will be sold. If the offering is contingent upon reaching a minimum threshold of subscriptions, like in an all-or-none or mini-max offering, investor funds are typically placed into an escrow account. These funds are only released to the issuer if the minimum number of shares is sold by a specified deadline, otherwise, all funds are returned to investors. This escrow arrangement protects investors by ensuring their money is safe until the contingent offering criteria are met. Question 22. When calculating enterprise value, EV, which of the following is typically added to equity value, market capitalization? A. Cash and cash equivalents. B. Accounts receivable. C. Total debt and minority interest. D. Prepaid expenses. Answer, C. Total debt and minority interest. Enterprise value, EV, represents the total value of a company, including its common equity, preferred equity, and all forms of debt, less any cash and cash equivalents. It is often considered a more comprehensive valuation metric than equity value, market capitalization, because it accounts for both debt and equity financing. To calculate EV, one typically starts with equity value and adds total debt, preferred stock, and minority interest, then subtracts cash and cash equivalents. For example, if a company has a market cap of $100 million, $50 million in debt, $5 million in minority interest, and $10 million in cash, its EV would be $100 million plus $50 million plus $5 million to $10 million equals $145 million. Remember that EV represents the cost to acquire the entire company, including taking on its debt. Question 23. What is the primary purpose of a Chinese wall within a diversified financial services firm? A. To physically separate the retail brokerage division from the institutional sales desk. B. To prevent the flow of material non-public information between different departments. C. To ensure that all client accounts receive identical investment advice. D. To restrict access to the firm's trading floor to only licensed representatives. Answer, B. To prevent the flow of material non-public information between different departments. A Chinese wall, or information barrier, is an ethical and regulatory barrier designed to prevent the unauthorized exchange of material non-public information between different departments within a financial services firm, particularly between the investment banking division and the trading or research departments. This barrier helps manage conflicts of interest and prevents insider trading. For example, if an investment banking team is advising on a merger, the Chinese wall prevents that information from reaching the firm's traders who might profit from it. Maintaining these barriers is crucial for upholding market integrity and preventing misuse of confidential information. Question 24. Which of the following best describes the cooling-off period in a public securities offering? A. The period after the IPO when the stock price is intentionally kept stable. B. The time during which the SEC reviews the registration statement before it becomes effective. C. The period after the offering's effective date when underwriters cannot solicit new business. D. The initial 90-day period during which securities can only be sold to institutional investors. Answer: B. The time during which the SEC reviews the registration statement before it becomes effective. The cooling-off period refers to the time after an issuer files a registration statement with the SEC but before the SEC declares the registration effective. During this period, which typically lasts at least 20 days, the SEC reviews the filing for completeness and accuracy, and underwriters can circulate preliminary prospectuses, red herrings, and gauge investor interest, but no sales can be confirmed. For example, investment bankers might conduct roadshows with prospective investors during this time. This period is crucial for allowing potential investors to review the offering information without the pressure of an immediate sale. Question 25. A company is facing significant financial distress and is considering a bankruptcy filing to reorganize its debts and operations. Which chapter of the U.S. Bankruptcy Code is most commonly associated with corporate reorganization? A. Chapter 7. B. Chapter 9. C. Chapter 11. D. Chapter 13. Answer: C. Chapter 11. Chapter 11 of the U.S. Bankruptcy Code is specifically designed for business reorganization, allowing companies, and sometimes individuals with substantial debts, to continue operating while developing a plan to repay their creditors over time. Unlike Chapter 7, which involves liquidation of assets, Chapter 11 aims to rehabilitate the debtor. For instance, a major airline or retail chain facing financial difficulties would typically file for Chapter 11 to restructure its debt and operations, hoping to emerge as a viable entity. Understanding the different chapters is key to navigating financial distress and restructuring processes.